Well, good evening everyone and welcome to tonight's Real Estate Investor webinar, Property Investment Finance Fundamentals. My name's Dennis Wong and I'm from Real Estate Investor, and I welcome everyone to tonight's content. We'll be joined by a very special guest as well, and I'll introduce him a little bit later on. So look guys, tonight's webinar, for those perhaps that are just looking for their first investment property, this should be a very educational hour or so. We've got plenty of time for a Q&A session at the end. So during the webinar, if there are any topics or any comments made by our special guest or myself, please feel free to just type in your question so you don't forget it at the end into the question section on the GoToWebinar panel, and we'll have plenty of time to go through all your questions then. So tonight we're going to be covering a few items, things like what the difference is between a bank and a mortgage broker, what are the benefits of that. We will highlight the importance of having the right finance structure in place. You can obviously, by having the wrong structure, can actually prevent you from investing in further properties and growing your portfolio effectively and efficiently. The difference between having one lender or multiple, what's the benefits of that, and also how lenders assess your application. So we've got plenty of content to go through tonight, so I really hope you enjoy it and take something new from it. And for those that perhaps got any programs running in the background, if you want to turn off anything like Outlook or Skype or any downloads that you're running, it will actually help increase the speed of the internet, and you'll have better audio quality. So look, we've still got a fair few people joining, so welcome guys. We've just started. Tonight's webinar will be covering property investment finance fundamentals. My name is Dennis Wong, so I've been a property investor for the past 10 years. I currently support over 500 members, helping them get to their next investment properties. I've got some personal experience with renovations, actually doing some at the moment myself. And tonight we will be joined, we are joined by a special guest, Paul De Silva, who is a mortgage broker from eChoice, and he's got over 7 years broking experience, 4 years leading a credit team as well for a nationally recognised non-bank lender. So he'll join us in a little bit later to take you through all the content. So perhaps you're joining us for the very first time. You've never heard of Real Estate Investor before. I mean, this line here essentially explains what we do. We help investors build and manage their property portfolios. I'm sure we've got a few members on tonight already, and we've also got some that perhaps are only using us for a free area for educational resources, but you do definitely get access to webinars and educational content such as this. So look, I'm just getting a comment that someone can't actually view any slides. So if anyone can see my slides, can you just let me know that you can actually view it? Sean, if you can't see it, you may need to just log off and join back in, but let me just double check to make sure everyone else can. Yeah, so they can. So thanks very much, guys. So yeah, Sean, if you don't mind, you might just need to disconnect and rejoin, and you should be able to see my slides. All right. So look, just a quick disclaimer as well, guys. Look, this presentation really just contains general information only, and it won't take into consideration your personal objectives, your financial situation or needs. So we do recommend that before you act on any information, should you do so, that we recommend that you seek advice from a qualified financial advisor and or an accountant. Now, look, I mean, these webinars are designed to be educational, so I really do hope you take a lot out of this, whether you're learning just property investing before you get started, or you're ready to go right now, or you're a seasoned investor. So really do hope you get a lot out of tonight. This is our mission statement. Real Estate Investor is essentially here to provide property investors around the world with the best advice, guidance, products and services to enable you to create wealth through property investment. A little bit about ourselves. So we've got around 2,800 current members who utilize our services. We're here to really help simplify real estate investment, allow you to focus on the numbers and try to take any emotion out of the purchase decision process. We do have a mix of personal users that utilize our services, from brokers, buyers agents, personal users and accountants, and we do have over 250,000 members who do actually access our calculators, market information, news and updates. Now, we are a publicly listed company. REV is our code, and we do have a very heavy investment in product, and we've got a very strong and focused board as well. So Simon Baker is our chairman, who's a former CEO of realestate.com.au, and we've also lucky enough to have Anthony Catalano, who's the current CEO of domain.com.au. Now, we don't do this all on our own. We do partner with other companies who specialize in different areas to help property investors. So we do have a partnership with Domain. We provide a lot of data to Your Investment Property magazine. A lot of our sales data, or most of our sales data, comes from APM Price Finder. For those that have heard of Xero, an accounting platform, so we partner with them from a tracking point of view to help our investors be able to manage their cash flow, and also when it comes to tax time, make it easier to get all your reports and copies of receipts and invoices out. And Washington Browns is another example of a company that they specialize in depreciation reports. So look, before we get started, I thought I'd just give you an idea, especially for those that are just starting out, and perhaps even for those seasoned investors, where do you sit at the moment in terms of property investment in Australia? And really, there are three levels of property investing. You got around 1.9 million Australians thereabouts. And we've got really those investors who have one property. They'll usually buy one investment property. It's usually negatively geared. They'll then eventually, well, at least for the first couple of years, then they'll eventually sell that off, pay down the debt on the PPR, or the home that they're living in, and at retirement they've essentially got no debt. Better off, but there's no investment properties where they're generating, or assets generating, any passive income. We then have those investors who have 2 to 4 properties. So they're usually people who perhaps have high income. They may have a couple of negatively geared properties to help reduce their tax. And then when it comes to retirement, if they've got 4 properties, they may sell down 2, pay off the debt off the other 2, and then they've got a couple of assets with some minimum retirement passive income coming in. Then we have those who are in the 5+ category. They're all about strategies and numbers. They essentially treat property investing like a business, and they've got the ability to essentially choose when they want to retire. They've got a portfolio that's fully balanced and generating passive income of anywhere between $100,000 to $250,000 from the rent. And when we look at those numbers from a percentage point of view, over 70% are stuck in that one property group. So for whatever reason, maybe perhaps they just only want the one investment property, or perhaps they've bought, they pay too much, and so obviously they've got no equity, or the value's gone backwards. That can restrict you from moving forward quickly. They perhaps might have had the wrong finance structures in place. They may have had building issues, tenancy issues, things that can be avoided with proper research. We've got about 25% in the 2 to 4 group, and then we've only got 2% that make it to that 5+ property group. So hopefully that just gives you an idea of where or how property investors in Australia sit in terms of different groups, where you're at, where you'd like to get to, and I guess what sort of traits you need to, or behaviours you'll need to display, or to be able to implement to be able to get there. So I thought I might take this opportunity. We've just got a couple of polls tonight just to get an idea on the audience. So, how many properties or investment properties do you currently own? So what I'll do, I'll just launch this poll on screen, and if you don't mind just clicking on screen, and I'll share it with the audience as well, just to get an idea on, whether we have a lot of new investors on tonight, perhaps we have some seasoned ones, or we've got some in that 5+ property group or 4+ property group. It'd be interesting just to see who we have on tonight. So I'll just keep that open for 5 more seconds, guys. So we've got over 60% have voted, so thank you very much. We do appreciate your participation. And I'll close that off in 2 seconds. 1, and I'll close that off. So thank you very much, guys. And I'll just share it with the audience. So we've got just under a third with 0 properties. So welcome, guys. Very exciting. Hopefully you've come along tonight just to educate yourself a little bit more on how to set yourself up from a finance point of view to get started this year. we've got 24% with one, and then not surprisingly, the numbers then start to dwindle down when we get to the 2, 3, and 4 plus group. So look, welcome everyone. We do have a mix of different investors, so you're not alone. So you can tell by the numbers there that we do have quite a number of people at different levels. All right, thanks guys. So let's I'll hide that and we'll get onto it. So this this is where now I'd like to introduce Paul De Silva. He's a mortgage broker from eChoice, and he's going to we're lucky enough to have him tonight to take you through some of the fundamentals. So what I'll do is, Paul, I'll just unmute you and hopefully everyone will be able to hear you. All right, Paul, are you there?
Yes, thank you, Dennis.
Fantastic, so I can hear you loud and clear.
Great, that's fantastic. So should I take it from here now?
Yeah, if you don't mind, Paul. So welcome, Paul, and look, everyone, I really do hope, you take advantage. Paul is very knowledgeable and he's presented with us before. So Paul, I'll take it away. I'll leave it, hand it over to you now.
Thank you, Dennis. Ladies and gentlemen, thank you for your time. Okay, so basically the topic, the first topic we're going to touch base on is basically the difference between a bank or a broker. It may sound like it's something that's pretty straightforward, but quite often people are unaware just how much value a broker can add to somebody who's trying to build a property portfolio. So it's important to sort of have this discussion first of all. I guess the most important thing here is that the mortgage broker is actually working for you and not for the bank. What they actually a successful mortgage broker will think of is the success of their client, because hand in hand with that success will be obviously the success of the mortgage broker himself. If you look after your clients, basically your business will look after itself. So you basically have the same goal. So you and your mortgage broker are partnering up and looking to strive the same achievement, which basically in this case for most of you it is to have build a property portfolio and achieving your retirement goals essentially. Banks, they basically won't help you maximize your LVR as you grow. For those of you who are new to lending or borrowing funds for real estate, LVR means loan to value ratio. That basically means the percentage of the property value that you actually borrow. So what's important there is that, and what I mean by this, that they won't help you maximize your LVR, is quite often you may have already a couple of properties in your portfolio tied in with your bank, and you may have sufficient equity in these properties to go out and buy another property outright. But what the banks tend to do is, rather than simply extracting the equity from your current existing portfolio and then giving you the funds to go and purchase that property so that you actually hold the title to this new property, they'll more than likely tie that new property in together with the ones that you already hold. So that's something that's very much common practice with some of the major banks, and what that does is basically it restricts your ability to sort of progress as a property investor. They're also very limited in the products that they offer. They have a product suite which will very much be, I'm sure, will service a very large percentage of the clients out there. But what actually happens is at some point those products may not be suitable to the client before them, so that it does actually restrict you in what you're able to do. And that goes hand in hand with their lending policy. So basically they have their one lending policy that they need to adhere to, and what happens is there comes a point when basically they're either not able to assist you any further with lending because of their credit criteria or because of the products that they offer. Mortgage brokers, as a rule, they have dozens of lenders available to them, and basically hundreds of products at our disposal. We also have a lot of lenders at our disposal that in the mainstream that you're not able to actually source. So a lot of private funders, when things get a little bit tougher with the property that you're purchasing, perhaps if something a little bit slightly outside the square, and quite often banks aren't willing to assist, that is something that a mortgage broker 9 times out of 10 can. Okay, and finally, basically a mortgage broker is your partner. As I mentioned before, they should be a facilitator, so they are basically there to look after you as a client, look after your financial requirements, make sure the finance is in place so that you can actually focus on researching your next purchase and actually building that portfolio successfully. Sorry, I don't think this is moving. Here we go. Okay, so the importance of having the right finance structure. What you need to determine basically to ensure if your finance is structured right, the first thing is you need to review your current financial position. This is incredibly important. We need to assess your income, the cash available you have for a deposit, what kind of equity you have in your existing portfolio that you can actually extract, and also your current finance structure, particularly if you've already got finance in place. So it's important to actually review that and see if there's any shortcomings there that need to be addressed well ahead of you then going out and looking for a property. We need to also assess the property that you're acquiring. So quite often the type of property, whether it's residential, commercial, whether you're buying something in a high density area, multiple occupancy, for instance, things of that nature will actually affect basically who will be able to lend you the money, and also how it needs to be structured so as to basically maximize your borrowing capacity. And the other thing, but last but not least, is you need to consider your future objectives and goals. It's all well and good, you know, you can go and get a loan to buy a house any day of the week, but what are your objectives in 6 to 12 months time? Does that lender then allow you in 6 to 12 months time to do what you're looking to achieve? That's also important to consider when you're actually looking to fund your purchases. Now, other things to consider is a bank relationship important? Look, it's good to have a relationship with your bank, particularly if you're a business owner. I think it is imperative that if you're in business, I've got a very good relationship with my business banker, but I don't think as a property investor that is as important to you. The reason is that basically no matter how well you get along with your banker, if they are unable to facilitate your objectives, the relationship isn't going to be a good one. It's potentially good for him, but it's not going to be good for you as a property investor. Should you cross-collateralize or let your property stand alone? Obviously, there are benefits and pitfalls to both of them. The situation, your personal situation and your goals should dictate what is actually appropriate here. So there are some benefits, things like if you cross your owner-occupied property with your very first investment property, for instance, just as an example, some lenders are out there will be able to actually offer you potentially an owner-occupied rate on both of those properties if you borrow more than 50%, if more than 50% of your borrowings are for owner-occupied purposes, for instance. So that's one example where cross-collateralizing can actually benefit you. But you know, there's a lot more involved there, and it really needs to take into consideration what you're trying to achieve before you actually go down that path. Is having the cheapest deal available the right strategy? I encounter this in my business all the time, where people come to me with 4 or 5 properties in their portfolio and they say, oh look, I'm giving you all this business, I want the cheapest rate around. Now, that's all well and good. You can potentially refinance all these properties and go and get an online lender to give you a really smoking hot rate. But when it comes time to purchase your next property, what is actually going to happen? I think what you need to consider is not getting the cheapest deal possible, but getting the cheapest deal in the right structure that suits your objectives, right? So not the cheapest deal available, but the cheapest deal available for your particular circumstances. That is always an important thing. And now, Obviously, we will try, as I know I do as a mortgage broker, we'll always try to find my clients the best deal rate-wise. Now, that's not always possible, particularly when people start buying very out-of-the-box properties that may be, fantastic generators of income, but they are slightly outside the box, and then unfortunately we do need to look at other avenues where we can actually fund these properties, which a normal lending institution may not necessarily touch. And what product is right for you? Well, again, it depends on your personal circumstances. You'll hear me say this a fair bit throughout the presentation, and the reason is because it really is a personal thing. So you may be best served to have an offset facility, perhaps, so that you can actually reduce your interest commitment. However, what you need to consider as well is that perhaps you've already got a couple of offset facilities and you're purchasing your 6th or 7th property, so another offset facility may not be of any benefit to you. So perhaps a basic product with a cheap interest rate and no fees is more appropriate. So this is the kind of thing that needs to be determined when you actually get your assessment carried out. And finally, what if you get your finance structure wrong? Well, in layman's terms, basically it's going to cost you money. It's going to cost you time and money. So you'll need to actually redo your restructuring of your loans. Quite often it can mean the time that it takes to do that, you could miss opportunities that that you are looking into at the time. So it is important to actually set your goals for 6-12 months time, communicate that with your broker, and make sure that these are addressed in your financing now, so that in the future you're not actually getting hindered in any way, shape or form. Okay, now one lender or multiple. Just again, no right or wrong answer here. I think though that this becomes a little bit more important when your portfolio grows, say, to 3 or 4 or 5 plus properties, because what will actually happen is at some point you will reach a level with your particular lender where that you either no longer meet or satisfy their servicing criteria, or the property you're going to buy is just in an area that they're not happy with, something of that nature, and you'll encounter a roadblock, and that's when it really is important to start looking at multiple lenders. The advantages and disadvantages of doing this, there is a bit of both, and it is important for us to actually assess your personal your situation and make sure that you actually get placed in the right area. Okay, so the advantages of actually dealing with one lender, you'd be looking at ease of extracting equity. So you can actually, you've got all your properties tied in with one bank. It'll be very easy for you to actually walk into your bank and say, look, I need to extract some equity from my properties. They'll go, value your properties, get it all done. So ease of administration as well. So you'll actually only have to lodge one increase or one variation to your home loan or to your portfolio, and a single application that can actually assess your loan account, review your conduct, because you have everything with them anyway. The documentation requirements are quite minimal because they can actually access all of your information. And the other thing is, obviously, because you have a larger amount of borrowings with them, you do have some leverage in negotiating rates. So they can potentially offer you a higher rate than you would, if you have, say, $1.5 million worth of borrowings, than if you did go there with, say, $300,000 or $400,000. So they'd be able to offer you a little bit more. Some of the disadvantages of using only one lender are basically changes in lending policy. Now, this was quite prevalent, particularly sort of last year when government actually started to control and take a little bit more, pay a bit more attention as to how quickly banks were lending for investment purposes. We did see a lot of lenders pull back investment lending back to 80% maximum. Some lenders actually stopped lending for investment purposes completely. So if you happen to be in an unfortunate situation where your particular bank just stops lending for investment purposes, that's basically you're at a disadvantage straight away because you've got all your equities tied in with them. It means that you're going to have to restructure your entire portfolio, take it somewhere else so that you can actually access somebody who can help you. Obviously restrictions of a single lending policy, that sort of ties in hand with the changes in their lending policy. So you could be, I think I mentioned before, you could be looking at purchasing a property that, you know, I don't know, could be 4 units on one title. The bank that you're dealing with may not be have an appetite for that type of property. So you're now got all your eggs in one basket. You now have to looking at other avenues. And obviously the maximum exposure limits, which is things that not a lot of people are aware of, in that a lot of banks have they'll have a ceiling level or a ceiling dollar figure that they will actually lend to any one borrower. So if you achieve maybe borrowings of 2 or 2.5 million, that could be their maximum exposure limit. It means that regardless of how good your credit limit is or your affordability is, they've just said thank you, but we don't want to lend you any more money. In the event that something happens, we're heavily exposed. So that can actually affect you quite dramatically. Okay, so multiple lender. Some of the advantages here, you're spreading risk. I believe in the spread of risk. Some will argue this point and think that it's, you know, it gets a bit tough if you decide that, you know, some people actually don't believe that you're spreading risk when you're actually sending it to multiple lenders. I think you are, because things happen. No one can predict the future. If things get a little bit tough for you and you decide that you need to sell one property in a hurry so that you can actually, you know, reduce your debt to a level where it's more manageable so that you can actually ride out the storm. If you've got your properties sort of spread out a little bit, you could select one that's, you know, got enough capital or enough equity there for you to actually do what you need to do, sell it, discharge the loan, use the money how you intended to, get over that hurdle and then get on with your life. If you have all of your properties cross-securitized with one lender, the process then becomes quite convoluted. So what you need to do is you need to get a valuation of all the remaining properties. And being in this industry for a few years now, I've come across, I don't think I've come across a day when people with multiple properties haven't had one valuation come in under. So what happens is basically with that, if you don't value, the properties don't value up to for you to be able to actually pay down just the amount that you need to extract the equity that you need, you may have sold the property and then not gotten sufficient equity out of that property to be able to do what you need to do. So you may have to look at selling potentially another one. So these are very heavy disadvantages of having everything secured with one lender, and something that you need to actually consider. Basically, you can also take advantage of specials. Banks are very quick to offer discounts for new borrowings. I don't know if you've ever noticed that. So you'll see specials that go on for 3 months, you know, such a bank is offering a red hot rate with a massive discount for the life of the loan. So if you're not stuck with one lender, you'll be able to take advantage of these things. And customers who will get stuck with their one bank often get fed more of the same. So you may not have the best rate on the market, but that's basically the same rate that they're going to sell you on the next one. And finally here, make use of capacity criteria. So, you know, no two lenders actually assess their servicing capacity the same, and you can actually use this to your advantage by going to the lender that will actually lend you the most amount of money at that point in your situation. Like anything, there's always a disadvantage to it. So multiple lender disadvantages. It can be tougher to extract equity from multiple properties. So meaning that you would have to potentially approach 2 or 3 banks to get sufficient equity out of your properties to do what it is that you want. New lender may have a higher assessment rate for debts that are not held with them. So however, what you can do is you can actually play the field in this area, so that this can be somewhat mitigated. in that you can actually look at lenders that will actually assess your serviceability more favourably, and more administration and possibly costs when you're actually trying to do something. So you may have multiple applications, you may have some additional legal fees. However, taking advantage of a mortgage broker, they would actually be able to do most of the paperwork for you. So by the time you come to a meeting, the documents are all there, ready to go, and you should be able to just sign a few more documents and get that side of things addressed. So, but there are, like I said, probably the toughest thing would be if you needed to go to multiple properties to extract enough equity for your next goal. But that's where it's important to actually assess the property that you're buying. Is this going to be a property that's going to acquire a lot of equity very quickly? If so, then you want to make it freely available so that you can actually work on getting your next property with the equity that you free up from this new acquisition. Otherwise, if it's going to be something that's going to grow very slowly, then you can probably put it aside somewhere where you don't need to actually look at it for maybe 3 or 4 years' time before you actually can extract equity from it, because it could be something that's returning a high yield in rent. Now, how lenders assess your application. Credit has the 4 C's. These are things, the rules that have been in place since I think the dawn of banking. This is how we, as credit analysts, will actually look at whether or not we want to lend somebody the money. I used to manage a credit team for a few years, and particularly capacity is probably one of the most important things that they look at, and I'll explain a little bit more on that a little bit later. Okay, so character basically means the person that they are lending to. This is basically what they're looking at. Collateral, that would be the security that you're offering, or the property. Capacity is your income position or your ability to repay the loan. And current conditions would be economic factors that would have an effect on whether or not they will lend you the funds that you require. Okay, so with character, the things that we'll be looking at, and this probably comes as no surprise to anybody, we'll be looking at your credit history. So they'll run a credit report. There's a couple of agencies out there that they run their credit reports through, and what they look at there is that if there's any payment defaults or any debts that you basically have not paid. So what they want to confirm is that you pay your bills. Now, not only do they look at negative information that's on that credit report, but ever since about 1.5 years ago, credit reporting agencies have now started taking information, what they call positive reporting. A lot of people aren't aware of this, but what happens is if you have a personal loan, for instance, for a car or something of that nature, and the lending institution is actually registered to do positive reporting. If you perhaps miss a payment by a week because you went away on your holiday, Christmas holiday, and you forgot that you had the repayment there, forgot about the repayment, you still have the money in another bank account, but your payment defaulted when you came back from your holiday and you made that payment a week late, it will actually register on your credit file that that payment was made a week late. So even though you may meet your commitments, if you're a little bit, say, bad at managing your money, my sister's a perfect example of this. She will pay her bills without fail, but without fail, she always pays them late. And what she's not aware of is that basically this goes against your credit history. And they call it positive credit reporting because they want to sell it as a good thing. They want you to know that, look, we'll want to make sure that we reward those people who pay their bills on time, but they also want to see people who pay their bills late. So it is important for you to remember that, have that in the back of your mind. If you've got a bill, please pay it on time, because that does have an effect on your credit history, and eventually it will affect credit scoring with a lender and whether or not they'll lend you any funds. The stability of your employment is particularly important. So they want to see that the person who's borrowing money has got a stable working history, so they're not going from one job to the next because it could mean that that person potentially doesn't actually have the ability to hold a job for very long. So that causes a little bit of instability. Erratic employment history can actually score you quite heavily in their scoring system. If you just bear with me, I'll just have a quick drink of water and I'll explain to you about their scoring system in just a moment. Thank you. So lenders have something, well, they have a scoring system, and basically if you score below a certain magic number, it's quite often your application gets rejected by the computer. It doesn't even hit anybody's desk. No one's even willing to look at it. So all these factors will actually affect your credit score. So having stability of employment, particularly things on your credit history nice and clean, that all is going to work towards you building up a good credit score with the bank, meaning that you will actually have a better chance of getting a loan approved. Now, obviously, if you are in a position where your credit scoring may not be the best, a good mortgage broker will be able to identify that, and what he will do is he will actually probably move you to or steer you towards a lender that doesn't necessarily credit score. So that's something else to keep in mind. So if your lender or the bank that you deal with on a regular basis has credit scoring, and you're in a position where your credit scoring may not be the best, you're probably going to fail before you even sit down on that chair. So it is important to actually consider that as well. And finally, the one thing that they look at as well is obviously your good asset position. They want to see somebody who's got some assets to their name. You don't have to have a property necessarily, but they don't want to see somebody who actually owes more money than actually what they own. So if you have a lot of unsecured debt, that's actually going to go against you quite heavily. Okay, collateral. Now, this is all about the security property that you're offering. So they want to make sure that the property you're buying is in a good area. So property that is in good repair, because obviously property in poor condition is not looked at very favorably. How much you're going to borrow against the property, so the LVR, something I explained earlier. The higher the LVR, or the more you borrow, the higher the risk is to the bank and the higher is the cost to you. Up to 80% is a very comfortable level of borrowing for a bank, so they're quite happy to lend you that money at 80% without too much cost involved. But once you actually go over 80%, then for them to actually take on the additional risk or the added risk, they will actually want you to take out mortgage insurance. So mortgage insurance is actually a policy that the bank takes out to protect them, and unfortunately the borrower is the one that actually pays for it. So for you, for the privilege of you borrowing the money from them, you are actually responsible for paying to cover them against any sustained losses should the worst happen and they have to sell your property. So that's something to keep in mind. And they also want to make sure that the property can be easily sold. So if things go wrong, and the bank wants to ensure that they get their money back. So if you're looking at properties in regional areas, potentially some areas a lender may actually restrict lending, say up to 70%, and that's in the event because regional areas may have they've got it's a slower market, smaller market. There's probably not a lot of turnover of properties in those areas, and in the event that they have to do a fire sale, they won't be out of pocket. So they've only lent you up to 70% of the property value. So if they have to sell it for a considerable amount less, they'll still get their money back and be happy. Okay, now capacity to repay. So what the bank will do here is they'll actually assess if you have the income to meet the repayments. But what people are not aware is that, or often not aware, is that their lending policies actually quite often disadvantages property investors. Now the reasons for this is that your rental income is discounted. So when when you assess the rental income, they'll actually discount it by about 20%. And the reason for that is so that as to account for cover the costs of managing the property, maintaining the property, paying rates, things of that nature. The interest rates that you're actually getting assessed at are assumed much higher. So you may be able to get a rate of, I don't know, 3.8%. However, your assessment rate quite often is, anywhere between 1.5% to 3% higher than what you're actually getting the money for. A lot of them also have what they call the floor rate that they'll assess your interest rates at, and that could be, say, 7.25%, for instance. So what they'll say is, if that margin on top of the interest rate you're getting offered is below 7.25%, they'll still assess your repayments at that higher level. Now, the reason they do that is, in a way, it's to ensure that you can actually, it is there to protect you in a way, so to ensure that you can actually meet those repayments in the event that interest rates do move up. But it's particularly in this market at the moment, where quite often people are getting assessed at almost double the interest rate that are actually getting offered from the bank itself. So that does have a detrimental effect. And obviously tax benefits that can be ignored. I'm talking particularly here specifically about negative gearing. All talk about making housing more affordable in Australia has led to politicians bringing up the fact that maybe negative gearing should be revoked. This has got a lot of lenders nervous, and what they've actually done is they've actually stopped considering any kind of negative gearing effect that you get from your investments as a tax benefit, because the potential is there that one day the government may decide to pull the plug on it. Now finally, current conditions. Now this is something that a lot of people don't think is considered by a bank, but I assure you that it is. What they look at are things such as your local economic factors. So is the local economy in the area that you're buying in a growth phase, or is it in retraction? If it's retracting, they may be a little bit more apprehensive about lending you the funds, even though the property could, be returning 6 or 7% rental yield, but because the area is in retraction economically, they may be a little bit nervous about providing you with a loan that you need to actually purchase that, potentially great investment. Another thing could be that the local employment situation, is it in a single industry town? Is this something that, are you buying in a mining town, or is the single most important employer in this town a car manufacturer? We've seen Toyota and Ford and Holden shutting shop in Australia permanently. So those kind of things do get actually considered when they're actually looking at the property that you're buying. The closure of these kind of industries in this kind of towns would have a detrimental effect to the property value and obviously the rental income and things of that nature. And finally, national and global conditions. Some of you may not remember it, but I remember it quite clearly. The GFC, some 8 odd years ago, that basically rocked the world. Some lenders actually pulled out of lending completely when the GFC hit. So it does have the current economic situation or conditions do play a very important part in lending and whether or not lenders will actually provide you with any funds. And back to you, Dennis. Thank you.
Fantastic. Thanks so much, Paul. Thanks so much for that. And look, if you're interested at all, guys, in a free loan review, you're more than welcome to go to that link and register. But what I might do is make it a little bit easier. I'll put up a poll. So if you are interested at all, guys, just hit yes, and definitely get someone from eChoice to get in touch to organise a financial check for you, just to give you an idea of where you're at, what your possible borrowing capacity is. It's no obligation, it's like anything, you can shop around, see if eChoice can get you a better rate or a better deal, like Paul said, it's not all about the actual rate itself, but the deal itself based on what you want to try and achieve with property investing and how you want to grow your portfolio. So I'll just leave that for a couple of seconds. I'll give Paul an opportunity to have a drink and before we hit the Q&A session. So what I think I might do is just take the opportunity to talk a little bit about a service that we're offering that we can also tie in the health check. So I'll just close this off, and I will paste that link into the chat section as well, guys, if you missed out on voting. So I'll just close that off for a second. And while what I like to do is just take the opportunity that real estate investors, so I talked about before about us providing products and services. So I'll just take 2 minutes just to talk about the new premium or the premium membership that we now offer. I mean, this is essentially a hands-off investor. You know, it's an easier way to purchase your first or your next investment property. And essentially, we use a 6-step strategic approach to perhaps help an existing investor. Perhaps you've got, you know, just the one property. We can help you grow your portfolio further. Or perhaps you're a first-time investor looking for your first property and you don't have the knowledge or the confidence. We can definitely help you using the premium membership. So this is just a graphical sense to show you our 6-step strategic approach. Essentially, the first step is just to assess your current position. We organise a consultation, get a really in-depth idea on what your goals are, what you want to try and achieve, what you know, over a long period of time, how many, you know, what types of properties you're interested in. Step 2, we then review your finance and structures, so we can get you in touch with someone like Paul, who can then obviously have a look at your financial situation, your structure if you've got one in place already, how they can possibly help you restructure if required to allow you to move it further. Then we will prepare a property acquisition plan based on your budget, your types of property that you're interested in. Essentially, that's the blueprint that we'll work from to help search for your property. Then the hard work comes in. We do all the research and the due diligence, and then we'll present you with opportunities that meet your criteria. And then we'll also help you during the property acquisition process, you know, give you figures, what the maximum amount you should be spending to make sure that you're still going to be profitable. And then we also help with your property review. So we'll you know, track the value of the property, how it goes up, cash flow, and really then you can identify when you can purchase your next property. So, you know, which property is right for you? So we'll work together with you. You know, essentially we'll become your partners with you, and whether your goal is to, you know, just boost or replace your income with passive cash flow. Like I said before, those in the 4+ property group or 5+ property group, you know, you get the ability to essentially replace your salary, choose when you want to retire, or, you know, perhaps you're looking at just generating equity for retirement, you know, through things like manufacturing growth via renovations or subdivisions. So the premium membership is great for first-time and existing investors. You know, we look at both existing houses and units in growth markets, but we do also have access to brand new off-the-plan apartments, dual occupancy properties, and duplexes as well. These are just a couple of recent deals, properties that we've helped our members purchase. The one in Gosford was an off-the-plan unit, and they've had a consistent roughly about 7.6% capital growth. Now those units were in a boutique complex. They started from about $435,000. Now our premium members got access to a $10,000 discount off that asking price, and then after the public release, the prices were around $455,000. So essentially, our members got an equity increase, you know, of about $30,000. The one on the right in Pimpama, North Gold Coast, was a cash flow opportunity for one of our members. The purchase price was around $693,000, but the pre-tax cash flow was roughly about $8,000. And then obviously, given that it's a new off the plan, there was depreciation benefits, and so the after-tax cash flow in the first year was a little bit over $12,500. For some existing stock, for some of our clients who were looking for something that already existed, down the bottom left corner there in Homeville in Queensland, we helped a client purchase a subdivision opportunity. So they purchased that at $310,000. Now, including purchase costs, so things like stamp duty and legals, and also the council cost to split the block, the total cost was then $400,000. Now, post the subdivision, the existing house at the front got a valuation of $300,000, and the vacant block at the back was valued at $220,000. So the total value was $520,000, and there's about $120,000 of equity on the completion of that subdivision. And then finally, a renovation opportunity that we helped our client purchase in Mount Gravatt in Queensland. They purchased it for about $580. The reno was about $60,000, and then there were comparable houses in the area for about $743 that were renovated, and so the equity gain there was, roughly around $100,000. So just a couple of examples that we helped our members purchase. Some of the advantages of the premium membership: there's full transparency on any opportunities that we recommend to you. So as part of it, you do get access to the real estate investor tools. So you can actually verify all the information, all the data that we're providing to you. We want to, be accountable for the stock that we're recommending to you. So you've got access to the same data that we do. We can recommend both new and or existing properties. So there's not one that we prefer. It's all based on what you want to try and achieve and what the return you're looking for. You'll get allocated a dedicated portfolio manager, so one point of contact to help you along the way. So we're an ASX listed business, so we've got strict regulations where we report heavily. So it's essentially keeps us honest. Make sure that we are presenting you good investment related stock. We do also have exclusive access to stock as well, so we'll actually be able to give you access to stock first released before the general public, like the one at Gosford. And of course, you can just leverage off our experience. We do this every day. We've helped a lot of members, build their portfolio, and we've also got access to different professional partners as well. And look, if you do end up buying an off-the-plan property, there is the opportunity to get a $5,000 actual cash rebate on settlement for some of the new stock that we have. So look, just a couple of questions to think about, where you're at the moment. Do you have a well-defined investing strategy in place right now? Do you have an acquisition plan that will help you find and research your next property investment opportunity? And do you have the time and know-how to implement those goals and to be able to create sustainable wealth and that the passive income that you're after? Now, look, if you answered no to any of those questions, don't worry. I'm sure there's a lot of other investors out there that are in a similar position. I've come across and I've spoken to a few that are in the same position as well, and that's where the premium membership can help. So look, if you're interested and you'd like some help, or you just want to see where you're at and whether we can help you, we do provide a free consultation. There's no obligation, 20 minutes to half hour of your time, just to get an understanding of where you're at. Now you can go to that link. I will post that link into the chat section as well, and I will put the finance one as there for you as well. So you're more than welcome to book in, and we can organise a time. Otherwise, what I might do is just put a poll up as well, make it a little bit easier. Just hit yes on screen if you like. And I'll leave that open for a couple of seconds, and we'll hit the Q&A session. So there's a couple of questions coming through. So if there's any other questions, guys, please just type that into the question section on the control panel. And Paul and I will now take some time just to go through some of your questions and make sure that you go away tonight with all the answers that you need, perhaps to help you refinance or be able to help you get some lending to be able to purchase your first property for 2017, or perhaps help build your portfolio further. All right, so I'm just going to close that off, guys. Thank you very much. So just put in your last votes if you're interested. All right, fantastic. All right, now what I'll do is I'll also just put in the other link for if you're interested in just the health check. I'll put that into the chat section as well. So if you missed out on the earlier poll, guys, you're more than welcome to just type into that link.